I'd say the biggest benefits right now is the low interest rates. So interest rates in the mortgage industry are the lowest that they've ever been. And now is the best time to take advantage. So we've had so many clients that are paying interest rates, in the mid to high threes, all the way up to 7%, sometimes even higher. So we've been able to help refinance those clients and get them interest rates in the twos and threes, depending on what term length they do and what their situation is, which saves them a ton of money monthly. It can save you a ton of money monthly. Now, this gives people extra cash flow savings each month to put towards, groceries, gas, other bills they might have, to pay off some credit cards they might have, things like that. Whatever you want to do with that monthly savings, you can choose what you want to do with that. All of our interest rates right now are fixed, so you don't have to worry about the rates fluctuating or changing at any time. I know we've refinanced a lot of people that have a variable rate right now, so that's another big benefit. And then when refinancing, what a lot of people don't know is you're able to skip 1 or 2 mortgage payments. So that puts even more money in your pocket now. And you get a refund check from your escrow account. So whatever's left in your escrow account, you're going to get a check in the mail. And then if you do a regular refinance, not taking any equity out of your home, you can actually get up to $2,000 called incidental cash back. So we could go into more detail with you about that, but those are just some of the benefits of, not only lowering your interest rate, but what that can do on a monthly basis. Another big benefit that I want to dive into is changing the length of your term. So again, depending on what your goals are, we've had a lot of clients extend their term back to a 30-year, which again, that brings in a lot more cash flow monthly for them to put into, other monthly debts that they might have. We've had clients shorten the length of their term, which saves them thousands of dollars in interest over the life of their loan. And they can shorten their term and lower their interest rate. So it's kind of like a double benefit there. I've had clients do that and they pay a little bit more each month in order to do that, but they end up saving thousands in interest. I've had clients do that where their payment actually stays almost the same. So they shave off years and then they're essentially paying what they pay right now. But again, they're going to end up saving a ton in interest. And then I've even had people shave off a few years and their payment is even still lower just because they had a super high interest rate on their current loan. So a lot of benefits of changing your term length. We even do flex terms. So we do anywhere from 8 years all the way up to 30 years and everything in between. So we do a 16-year, a 17-year, an 18-year, 21-year. So I've had clients keep their term length the exact same and then just lower their interest rate, which again saves them more money monthly.
Yeah, to jump in on that real quick, Kate, too. So from my experience and just working with a lot of clients too, the flex term that we can do, so a 17-year, a 22-year, an 8-year mortgage, it really is something that not a lot of people know about. And I would say one of the biggest misconceptions that people have with refinancing is that if I refinance, I have to start over. So I'm going to have to do a new 30-year fixed, and more interest per month is going to be paid. The amount of principal per month is going to go down, all because I'm refinancing to save a little bit of money. And not a lot of people want to do that. So to your point, we have a lot of people, I've had a lot of clients that have 27 years left on their mortgage. They want that lower interest rate and it makes sense to get that lower rate, but they don't want to add that extra 3 years and kind of erase some of the amount of principal that they have paid down by extending it out another additional 3 years. So I have a lot of clients that would do a 27-year mortgage. And to your point, maybe they pay extra at some point because their payment's probably going to go down, but they also save a lot in interest in the long run because they don't have to go extend it out for another 30 years. So that really helps. I also had another client a couple of weeks ago that wanted to retire in 9 years. That was their goal. They want to retire in exactly 9 years. They've worked at one of the big 3 for a very long time, and they want a 9-year fixed. So that was something that we were able to accommodate, where a lot of other companies can't. And we structured it so in 9 years, their mortgage is completely paid off. That was very impactful for them on their retirement. They didn't want to have to retire where their income's probably going to drop and still have that mortgage sitting around. So they wanted to do that, get it paid off.
So another benefit I want to dive into is we've had a lot of clients that have refinanced and they've been able to either get rid of their PMI, private mortgage insurance, or greatly reduce it. So, when someone has less than 20% equity in their home, that's when they pay PMI, private mortgage insurance. And because home values have increased so much in the past few years, it makes it possible for someone to either reduce it or completely get rid of it by refinancing. So for example, we work with a lot of we have exclusive relationships with a lot of PMI companies, which is why a lot of times we're able to reduce the PMI that someone pays. So say someone bought a house, in 2020 and put 5% for a down payment, and then they come to us wanting to refinance. Maybe we can't completely get rid of the PMI, but we're going to still reduce their monthly payment by reducing how much PMI they're paying. So, if they're paying like $150 a month right now for PMI, and we refinance and get them down to 40 to 50 bucks a month or PMI, whatever the situation is. But we've done that for a lot of clients as well. And then we've even been able to clients who first bought a home and were put into an FHA mortgage, we've been able to refinance them into a conventional mortgage, which goes to my previous point. If you go to a conventional loan, you have the opportunity to eventually get rid of your PMI or get rid of it altogether when you refinance. The last benefit I really wanted to dig into now, this is probably the biggest one we've seen this past year, is people being able to tap into the equity in their home. So the average home in America in 2020 picked up over $20,000 in equity. And over the last 4 to 5 years, there has been substantial growth in home equity throughout the whole country. So this is a great time to do different things. You can consolidate high interest credit card debts. You can pay off student loans. I know a lot of people are taking out equity to do home improvements. So I've had a lot of people say they want to remodel their kitchen, they want to remodel their bathrooms, they want to put a new roof on, they want to, put new windows in, whatever your goals are. Some clients take out equity to help with a down payment. If they want to buy a second home up north and they don't have the cash right now for a down payment, you can take out equity in your home and use that cash to put on a down payment on a second home. I've had people, who invest in the stock market, they take out equity in their home and put that into investments because they think, they realize that they're going to get a greater return there than just letting the equity sit in their home. So, whatever you want to do with the equity that you've built in your home, it's your money. So, you can take it and do whatever you want with it, essentially. So those are just some of the major benefits that we've seen this past year, especially in this low interest rate market. That we'd love to, like Phil said earlier, do a 5-minute mortgage review and just see if it's something that would make sense for you.
Yeah, and one of the things to kind of piggyback on that, Kate, is with the cash out. One of the things I love going over with people is roughly today on a mortgage with how low interest rates are, every $1,000 that you can get back in cash at the closing table, $1,000 is only about $4 to $5 per month on your mortgage payment. So there's a lot of times where people will come in wanting to consolidate some debt. They'll want to do a home renovation and we can get them 20,000, for example, and their payment only increases by $90, $95 a month, maybe $100, depending on the exact situation. But you can get a lot of money out of your home to do those things that you desperately want to do with paying off high interest rate credit cards at 12, 18, 24% I saw recently. So you can get that money and it's not going to drastically raise your payment, which is a question that Kate and myself and the other home loan advisors get a lot, is if I do take money out, is my payment going to go up a lot? Am I going to have to pay a lot more monthly? And it kind of deters a lot of people from probably looking into it. So I want to make sure everybody knows that a couple dollars a month can really help you get that cash out that you desperately need.